Hello everybody, it's Yashar here, back again with another video, and in this video I'm going to talk about PayPal stock. I recently published a poll on my channel and asked you which stocks you want me to review, and PayPal ranked third based on your votes. I already published stock analysis videos on Canadian Pacific and Canadian Tire stocks, so here we go with PayPal. In this video, I will discuss the PayPal business, the growth and future plans for 2023 and beyond, the risk associated with this company, and finally, I will provide you this detailed stock analysis using my personal discounted cash flow model, and will then provide you with a fair value of this stock depending on your investment goals. The company HQ is located in California, and their shares are traded on Nasdaq for almost $79 at the time of recording this video. They don't pay a dividend yet, and the market capitalization of the company is around $90 billion. PayPal price chart is for sure a disappointing one. 5 years ago, PayPal had the same share price that it has today. And while the stock went on a crazy bull run during COVID, like many other tech stocks, it's been on a significant downtrend for the last 16 months, from almost $310 per share to lows of $66 per share. In this video, I want to analyze the PayPal business and their financial statements and share my opinion on this company as an investment. Before starting the video, I want to emphasize that I'm not a financial advisor. This video is not a financial advice for you to buy, hold, or sell this stock. This is just my personal opinion. You should always do your own research before making any financial decision. With that being said, let's start this video. PayPal enables digital payments between merchants and consumers and also between friends and families worldwide. The company also owns Venmo, which together with PayPal are two of the most popular and most downloaded finance apps in both Google Play Store and Apple Store. PayPal supports over 100 currencies and withdraw funds to bank accounts in 56 currencies, which shows the global scope of PayPal business. While there is a strong competition in fintech space, I think PayPal has a relative moat in digital payment processing business, and most of the businesses and consumers trust the brand of PayPal for their digital transactions over other platforms. I do agree with these statistics here from PayPal management, and I think trust is a moat in fintech and digital payment world. If I want to buy a product online and the website offers me to pay through PayPal, I feel confident about buying that product through that website because I know PayPal and I trust their brand, and I know my money and information is relatively protected because I'm paying through PayPal. As another example, I used to work for Samsung as a freelance developer, and the only way I could receive my salary was through PayPal, no other digital payment platform. And this is the relative moat that I talked about before. PayPal had an explosive growth rate during COVID in digital payment processing, but the growth rate slowed down significantly in the past few quarters, which is of course totally normal, as the world goes from everything remote, online shopping for everything, and work from home to a more balanced and hybrid in-person remote situation. As you can see here, PayPal total payment volume, or TPV, is growing significantly year after year, and right now each quarter they process more than $300 billion in payments around the world. In the last 3 years alone, on a fixed currency and FX basis, TPV based on PayPal checkouts around the world grew by 26%, and Venmo peer-to-peer payments grew by 55%, which is impressive. They have almost 432 million active accounts, which is grew by 4% in the last 3 years. Their revenue grew by almost 16% year over year during the same time frame, and their free cash flow grew by almost 37% year over year in the last 3 years, which are all great growth metrics for the company. According to the company expectations for the fourth quarter earnings report, which will be released soon, they predict to be able to grow their revenue by almost 10% year over year in 2022, and they expect around $5 billion free cash flow and around $4.08 earning per share, which is of course their non-GAAP EPS. There is a significant difference between their non-GAAP and GAAP EPS, which is mainly due to effect of stock-based compensation of PayPal employees, and I personally like to look at their free cash flow instead of their EPS and earnings due to these varying accounting measures they use in their income reporting. PayPal recently introduced reward program to US consumers. They introduced buy now, pay later options. They signed new partnerships with various retailers and e-commerce platforms, and they introduced crypto payments using Bitcoin, Ethereum, and Litecoin to open up new revenue streams for the company in the future. So far, I talked about mostly positive aspects and potential rewards of their business, and now let's focus on potential risks of investing in PayPal. I think there are several risks associated with investing in this company, and all of them, at the end of the day, can result in even poorer profitability metrics for the company. They had poor profitability metrics in the last few years, despite very nice growth in the revenue and their cash flow. And these risk factors can contribute to the same trend down the line unless the company basically decide to address these issues. The first risk factor, in my opinion, is their competition. While PayPal has a relatively moat in payment processing business, they face a strong competition from various small and large companies around the world for market share, which means a lot of potential pressure on their margins in the future. Another risk factor is operation costs of the company, which is going up rapidly in the past few years. For example, let's focus on stock-based compensations. Stock-based compensations in PayPal is one of the key factors which hinders the real profitability of the company. As you can see here, every single year they increase their stock-based compensations for employees by a significant number, which means the real operating margin, considering the effect of share-based compensation, is so much lower than the reported number under non-GAAP financial statements. For example, operating margin under non-GAAP statements is about 24.8% in 2021, while the real operating margin, considering the stock-based compensation effect, is only 16.8%, which is a huge difference in profitability of the company. Another risk factor is the history of poor capital allocation by the management of the company in recent years. In 2020 and even 2021, when the share price of PayPal was at its all-time high and the valuation of the company was just astronomical, it's completely in a bubbly territory. The management of PayPal decided to allocate 1.6 billion and 3.4 billion US dollar to buy back their shares. They also spent almost $7 billion in acquisitions at the same time when valuation of all the companies was at all-time high. Buyback is nice, but buying back the shares at the wrong time when the share price are overvalued is not a good capital allocation decision and demonstrate the poor judgment of the management team. Combination of strong competition, higher operation costs, stock-based compensations, and weak capital allocation resulted in poor profitability metrics for the company in recent years. The return on invested capital, return on assets, and return on equity was down compared to the 5-year average of the company in the last year. And overall, these are not great profitability metrics to be honest, particularly for a software business, which should have amazing margins and profitability metrics. So, why I don't like their capital allocation and profitability trend, we should still evaluate the stock considering all these parameters and see if it is undervalued or overvalued based on our assumptions. This is my favorite part of the video, where I can show you my stock analysis based on the financial data that I discussed in previous parts of the video. I use a discounted cash flow model, which basically estimates the value of stocks based on projections of their future cash flow. So I make some assumptions about the growth of the company in the next 10 years and then discount the future cash flow into the present value of the stock based on my expected rate of return. So I start with the past 4-quarter free cash flow of the company, and based on 3 different scenarios, I predict the future cash flow of the company in the next 10 years. In the bear case, or the most negative case for the stock, the company can grow their earnings by 8% in the short term, and then the growth will slow down to 4% in the long term. This is a conservative growth assumptions, and this is the case that PayPal management fails completely, I would say. I consider terminal multiple of price to cash flow of 10 for this case, which is consistent with historical bear periods of similar companies. For normal case, I consider a little bit better growth and a terminal multiple of 18, which is historical average multiple for a similar software business. For the bull case, or the best possible outcome, I consider the business grew by 18% in the short term, and then the growth rate drops to 12% in the long term. And I consider the terminal multiple of 26, which is a bull multiple for a similar type of the business. Now I assign 50% chance to normal case, 25% chance to bull case, and 25% chance to the bear case. For growth stocks, I usually expect 15% return, and for dividend and or large stable stocks, I expect 10% return. With PayPal, I actually expect a little bit better return than 10% as I believe this is a risky company and I need some margin of safety. If I expect a 12% return from this stock, the fair value of the company is almost 83 US dollar, which means compared to the current share price of almost $79, the shares are traded almost close to their fair value at a 6% discount today, which means it is a buy according to the model. If you're happy with the 12% return. I personally think 12% is not enough margin of safety for me. I expect 15% return. So if I expect 15% return from PayPal, the fair value is close to $64 per share, and compared to the current share price of $79, it is a little bit overvalued. I personally would start a position in PayPal if the share price drops below $65, and if not, I pass. There are other opportunities out there for me. In summary, PayPal is a good business with a relative moat in digital payment processing, and they are growing their business and their free cash flow and revenue year after year. However, I think there are some risks associated with investing in this company due to strong competition, high operating costs, and poor capital allocation by management in the past. I think the stock is currently trades close to its fair value for a 12% return year over year in the next 10 years. But you should always do your own research to see if the risk reward profile matches your investment thesis. I hope you enjoyed the video. And if you enjoyed the video, consider subscribing to the channel to see similar videos. Thank you for watching, and I hope to see you guys in the next video. Farewell.